You've probably seen the videos. The rich own nothing. It sounds brilliant. A clever structure, a limited company, everything tucked away, and HMRC can't touch it. You're 58. You've spent 2 decades building a £200,000 pot inside your company, and you think this is exactly what the smart money does. Then you need £30,000 for a new roof, and suddenly that corporate structure you've been told is your shield becomes a wall. Because to get that money out, HMRC could demand 33.75% before you've even paid a contractor. That's not a misprint. That's the Section 455 charge, the price of borrowing from your own company. On £30,000, you're looking at over £10,000 disappearing straight to the taxman. I've watched pre-retirees walk into this. They've done everything right. They saved, they structured, they took advice. And then, at 60, when they actually need the money, they find out the strategy was designed for people still earning, not for people trying to live off what they've built. Owning nothing works brilliantly when you're accumulating. When you're drawing down, it's a different game entirely. You don't need to control assets. You need to spend them. In this video, I'll show you the real numbers, why the rich own nothing playbook can cost retirees thousands, and what a smarter structure looks like, one that protects your savings without locking you out of your own money. Let's start where the confusion begins. What that corporate structure actually does in retirement, and why the numbers don't add up the way most people think. Let's talk about what a limited company actually does for you, and when it stops working. When you're 40, earning well, and putting money into a company, the structure makes sense. Corporation tax at 19% on profits below £50,000 is lower than income tax at the higher rate. You can leave money in the company, let it grow, and only pay yourself what you need. It's legitimate, it's common, and for the right person at the right stage of life, it genuinely works. But here's what changes at 60. You're not earning income into the company anymore. You're trying to get money out. That shift, from accumulating to spending, changes everything about how the tax maths works. Let's use a real example. Suppose you own a single rental property generating £30,000 in profit this year. If you hold it personally and you're a basic rate taxpayer, you pay income tax at 20%. You keep £24,000. Now run the same numbers through a limited company. The company pays corporation tax at 19%. So £30,000 becomes £24,300. Then you need to extract that £24,300 as a dividend. After the £500 dividend allowance, you pay dividend tax at the basic rate of 8.75% on the remainder. You keep roughly £22,200. The company cost you nearly £1,800 on a single property, for no benefit at all if you're a basic rate taxpayer without the kind of mortgage debt that Section 24 was designed to help with. That's the point most of the rich own nothing content skips over. The strategy was built for landlords with large mortgages, where keeping profits inside a company let them sidestep the restriction on deducting mortgage interest. If you don't have that problem, and many people approaching retirement don't, the company adds cost and complexity without any real reward, and the double tax problem gets worse as you take money out. When profits sit inside a company, they've already been taxed once via corporation tax. When you extract them as a salary, you pay income tax and national insurance on top. When you extract them as a dividend, you pay dividend tax. Either way, you're paying twice on the same pound. For someone still working and reinvesting, that second layer of tax might be deferred for years. For someone who needs to live off that money now, it's immediate and unavoidable. I've been close to situations where this hit people hard. A man in his early 60s, professional background, had been putting money into his company for years because his accountant said it was efficient. It was efficient, while he was earning. The moment he stopped, the structure became a tax machine pointed in the wrong direction. Think about what that looks like in practice. Suppose your company has £80,000 in retained profits. You want to take £20,000 a year to top up your state pension. As dividends, that £20,000 minus the £500 allowance is taxed at 8.75% if you're a basic rate taxpayer. You'd net about £18,300. That's manageable. But if you're a higher rate taxpayer, or if those dividends push you into the higher rate band, the rate jumps to 33.75%. Suddenly you're keeping roughly £13,400 of that £20,000. The difference between those two numbers is not a tax quirk. It's just under £5,000 a year. Over a decade, that's nearly £50,000 gone, not to your retirement, but to a structure that was never designed for spending. So why do people keep using it? Partly habit. Partly because the advice they received was right for who they were at the time, but nobody revisited it. And partly because the structure does feel safe, like having a wall between your money and the world. That feeling is real. But the numbers behind it at this stage of life often aren't. The question isn't whether a limited company was a good idea. For many people it was. The question is whether it's still the right tool now that the goal has changed from building to spending. And the answer, for most retirees on a basic rate of tax, is no. Which brings me to the part that catches even careful, well-advised people off guard. Here's the scenario that trips up more people than any other part of this. You need a large sum of money, not rental income, not a salary, but a lump sum. Maybe it's £40,000 for a car. Maybe it's a deposit on a holiday property. Maybe it's just a kitchen that's been looking sorry for itself for 15 years. The money is sitting in your company. You're the director. You think, I'll just borrow it from the company, pay it back when I can. That's called a director's loan, and on the surface it sounds sensible. The problem is a tax rule called Section 455. If you borrow from your company and that loan is still outstanding 9 months after the end of your company's accounting year, hmrc charges the company 33.75% of whatever is outstanding. On a £40,000 loan, that's £13,500. Not a fine, not an estimate, a real tax bill, due and payable. Now, the Section 455 charge is technically temporary. It's repaid to your company once you repay the loan. But here's where it gets difficult for someone in retirement. If you don't have other income coming in, how do you repay it? You'd need to extract more money from the company to repay the loan, which means more dividend tax or salary tax on top of the 33.75% you've already triggered. You can end up paying tax on the same money more than twice. I used to think a director's loan was a smart way to access company cash without triggering an immediate tax charge. Then someone close to me, 62, recently retired, had been running a small consultancy for years, borrowed £35,000 to renovate his home. His accountant missed the deadline. HMRC came back with just under £12,000. He wasn't a reckless person. He was organised and careful. But the rule caught him because nobody had explained what 9 months actually meant in practice. That experience changed how I think about this entirely. The deeper issue is that the director's loan was designed as a short-term bridge for a business owner who'd have income next quarter to repay it. It was never meant to be a retirement withdrawal mechanism. When you use it that way, the tax system treats it as exactly what it looks like, a way to extract profits without paying the tax due on them. And if you're 62 and your main source of income is the company, you may not have a clean path to repayment. The loan lingers, the charge stays, and every pound you extract to repay it gets taxed again on the way out. So the company doesn't just cost you more per pound than personal ownership. In certain situations, it can cost you a third of a large lump sum just to access your own money. That's the control versus ownership gap, and it runs deeper than most people realize. There's a phrase that does a lot of heavy lifting in these videos: the rich focus on control, not ownership. It sounds profound, and for a certain kind of wealth, a business still generating income, assets that can be moved around tax efficiently, it makes sense. But when you're 62 and you need to pay for care home fees, control without cash is just a feeling. You cannot hand HMRC a spreadsheet showing your company's net asset value and tell them it covers your rent. You cannot use shares in your own company to replace a boiler. You can't eat control. And when a real cost lands, a medical bill, a care need, a family emergency, what matters is whether the money is actually accessible. Let me show you what this costs in real terms when it matters most, when you sell. Suppose you hold a property in a limited company. The property is worth £400,000 and you originally paid £200,000, so the gain is £200,000. The company pays corporation tax at 19% on that gain. That's £38,000. You're left with £162,000 of after-tax profit inside the company. But it's still inside the company. To get it out, you extract it as a dividend. If you're a higher rate taxpayer, that dividend is taxed at 33.75%. On £162,000, that's another £54,675. After both layers of tax, you walk away with roughly £107,000. Now hold the same property personally, the same £200,000 gain, the same sale. If you're a higher rate taxpayer, you pay capital gains tax at 24% on the gain. That's £48,000. You keep £352,000. Two properties, same price, same gain. One path gives you £352,000, the other gives you roughly £107,000. The company path doesn't just cost more, it costs catastrophically more, because every pound inside that company gets taxed twice before it reaches you. That's the control versus ownership fallacy, laid out in pounds and pence. Now, there are situations where the company maths works better, particularly where there's mortgage debt, where Section 24 would otherwise cripple your returns personally, or where profits can be left inside long-term and extracted gradually in lower-rate years. Those are real scenarios, and I'm not dismissing them. But they require active management, proper planning, and a clear exit strategy. What most people in their late 50s don't have is that exit strategy. They have a company that served them well for 20 years, and they haven't been told, clearly and in plain language, that the rules of the game changed when they stopped needing to accumulate. The company felt like protection. The numbers say it's a tax amplifier at the wrong end of the journey. And that brings me to what I'd actually recommend instead, a path that gives you more liquidity, less complexity, and often more money in your pocket at the end. If a limited company is the wrong structure for this stage of life, what does the right one look like? Not a complicated alternative, not a new scheme with a clever name. The answer, for most people in their 50s approaching retirement, is simpler and less interesting than the videos would have you believe. Start by stopping the accumulation inside the company. If you have retained profits sitting there, the goal is to extract them gradually, staying within your basic rate band, rather than leaving them to compound inside a structure that will tax you again when you eventually take them out. Use dividends for income, not directors' loans. Keep each year's extraction within the amount that keeps you in the lower tax band. The second step is to use your pension as the primary exit route. Your company can make employer pension contributions directly into your pension, up to £60,000 per year, with the option to carry forward unused allowance from the previous 3 tax years. That contribution reduces your corporation tax bill immediately because it's treated as a business expense. The money then grows inside the pension without further tax. And when you reach 55 or 57 from the 6th of April 2028, you can take 25% of your pension as a tax-free lump sum, with the rest taxed as income. Compare that to the dividend route. On £60,000 of pre-tax company, profit corporation tax at 19% leaves you with £48,600. Extract that as dividends, and basic rate dividend tax at 8.75% after the £500 allowance takes you down to around £44,500. You've kept roughly £44,500 of your own £60,000. Put the same £60,000 into a pension directly from the company, and the full £60,000 goes in. No corporation tax, no dividend tax. £60,000 saved, not £44,500. That's a difference of £15,500 on a single year's contribution. I remember a client, 61, had been running his own consultancy company for nearly 20 years, who had £180,000 sitting in retained profits. His accountant's advice was to leave it there. "It's tax efficient," he said. Then his wife needed a private hip replacement, £12,000. He couldn't access it cleanly. The 33.75% charge loomed. That's when the idea of a simple ISAR started to sound less boring and a lot more like freedom. For rental property specifically, keep it personal where you can. If you don't have large mortgage debt, meaning Section 24 isn't a material problem, the double tax structure of a company adds cost without benefit. Own the property directly, pay income tax on the profit at your marginal rate, and when you sell, pay capital gains tax once, not twice. This isn't about finding a clever trick. It's about matching the structure to the goal. The goal at 60 is spending what you've saved, not just protecting it from the taxman on paper. Liquidity, simplicity, and tax efficiency in that order. Which brings me to the part of this that most people get wrong psychologically. I understand why a limited company feels like the safe choice. If you've watched friends go through a difficult divorce and lose a house in the process, or seen someone hammered by a surprise tax bill, the idea of a protective shell, a legal entity that sits between your savings and the rest of the world, feels enormously reassuring. It's not a silly feeling, it's a rational response to real events that you've witnessed. So if you've ever thought, "I need the company to protect what I've built," I get it completely. That instinct comes from somewhere real. But the protection is more limited than most people think. Shares in a limited company are a matrimonial asset under the Matrimonial Causes Act 1973. If your marriage breaks down, your ex-spouse can, and often does, have a claim on those shares. The company structure doesn't stop that. Only a prenuptial agreement or a properly structured trust can do that. The corporate veil protects you from trade creditors and some forms of liability, but it doesn't stand between you and a family court. And for tax purposes, HMRC has been steadily tightening the rules around structures that exist primarily to reduce tax rather than to conduct a genuine trade. If your company holds passive investments, rentals, retained cash, and you're no longer trading, the protections you think you have may be thinner than your accountant has suggested. The shift I'd encourage is this. Instead of thinking, "I need a structure that owns my money," try thinking, "I need savings that I can actually reach, backed by proper insurance and real legal planning for real risks." A well-drafted will, a lasting power of attorney, appropriate life cover, and a paid-off property alongside an ISA and a pension, that combination is not glamorous, but it's solid in a way that a dormant limited company often isn't. The company felt like a fortress. For many people at this stage of life, it's closer to a locked room with a complicated key. So where does that leave us? The rich own nothing idea works well for people who are still building. It defers tax, limits liability, and keeps wealth inside a structure that compounds over time. For an accumulator in their 40s with large mortgage debt and growing income, it can make real sense. For a retiree who needs to spend what they've built, it's often the wrong tool. The company locks your money behind a tax door. Every pound you extract costs more than it should, and the protection it offers against divorce, against HMRC, against creditors, is narrower than most people realize. The simpler path, a well-funded pension, an ISAR, a paid-off property, and a clear drawdown plan, is often more tax-efficient, more accessible, and less expensive to maintain than a dormant company. I don't know every detail of your situation. Your tax position might be different. Maybe your company still serves a real purpose. But if you're a basic rate taxpayer with modest mortgage debt, and you're not actively trading, it's worth sitting down and asking your accountant one direct question. At my stage of life, does this company still save me money, or does it cost me money? The answer might surprise you. If you found this useful, and you're thinking about how to protect and spend your retirement savings without handing more than you need to the taxman, subscribe. I'll be back with more on how to actually keep what you've earned. And if you've used a limited company for property or savings, drop a comment below. I read everyone, and I'll do my best to answer in a future video. Thanks for watching.